Which question was that? May 2019 question 3B, eh? That was the assignment. So you thought that Matatizo Limited has been recording losses for the last few years. The financial position of the company as at that 1st of March 2019 was given below. Now that's what we call the broke-off method. Eh? The broke-off method, that means that whenever the company mostly is not a going concern, instead of debiting the asset, they credit. Instead of crediting the liability and the equity, they debit. And that's what you have. Eh? Yeah, so we see that now under capital reduction account, you just need to master the format, whereby the major objective of preparing the capital reduction is to write off the accumulated losses. So here we have the accumulated losses, whereby on the credit side, we have the assets, that's the goodwill, planted machinery, equipment, receivables, inventory, cash in hand, patents and trademark. Then we have accumulated losses. Now, equity and liability should be credited. So what they did, they debited the equity and liability. They were supposed also to debit the retained earnings, but in this case, they had accumulated losses. So that's why they debited as part of the asset. So the accumulated losses was an amount of 2,000. And then you also need to prepare the ordinary share capital, though in this case was not required, but let me just show you, whereby you start with the balance brought down. So for the ordinary share capital, we have the equity share capital, which is that 1,000. Yeah, so equity share capital of 10 shillings per value is that 1,000. So that means we have 3,000 ordinary shares. Yeah, then we have the 10% preference share capital of 100 per value. Then we have the share premium. We have loan from directors, bank overdraft, creditors, and 12% debentures. The other share capital of Matatizo Limited is composed of 5 million equity shares of 10 each. So that means the power is 10. And 200,000, 10% preference share of 100 each. It was decided during the meeting of shareholders and directors of the company to carry out a scheme of internal reconstruction with effect from 1st of April 2019 as follows. So what were the terms? Number one, equity, each equity share is to be redesignated to shares of 4.5. Yes. So there was capital reduction. Eh? So you have capital reduction. Now each share of 10, because that was par value, was to be written down to 4.5 shillings. So that means the loss per share was 5.5 shillings. And then you multiply by the number of ordinary shares. So this was per share. And then we had 3,000 shares. So now give me the total capital reduced. Yeah, 16,500. Good. So that means of this balance program, they have sacrificed 16,500. So here we have capital reduction, an amount of 16,500. Then you debit and then you credit the capital reduction account. You show that the ordinary shareholder, they have sacrificed an amount of 16,500 to enable the company to write off the accumulated losses. I will tell that in number one, that each equity share is to be designated shares of 4.5 shillings. The equity shareholders are to accept the reduction in the nominal value of their shares from 10 shillings to 4.5. So they accepted. In addition, the shareholders are to subscribe for new issue of shares. New issue of shares. On the basis of 1 share for every 3 shares held at a price of 6 shillings per share. Yeah, so they also effected a rights issue. Yeah, because they are issuing shares to the existing shareholder. And what was the term? So you told that Yeah, in addition, the shareholders are to subscribe for a new issue of shares on the basis of 1 share for every 3 shares held. So for every 3 shares held, you subscribe for 1 share. What about, so they have 3,000 shares. That means they buy a new 1,000 shares and the issue price was 6 shares. So that means the company raised an amount of 6 million. So how do you take that transaction? So what are you supposed to debit and credit? Now you debit cash or bank account with an amount of 6,000. Then you credit the ordinary share capital. And the ordinary share capital should be recognized at par value. So we issued 1,000 shares, but the shares should be recognized at par value. Remember, the shares were written down to 4.5. So that means the current nominal value of the par value is 4.5. So 4.5, so that's 4,500. Then you credit share premium. For the share premium, we take 1,000 shares. We issued at 6, but the par value was 4.5. So there was a premium of 1.5 shillings. So an amount of 15. And that one will affect our ordinary share capital. So you have the balance go down. They effected a rights issue at par. You had an amount of 4,500. Number two. The existing preference shares are to be exchanged for a new 55,000 15% preference shares of 100 each and 500,000 equity shares of 4.5 each. Yeah, so did the preference shareholder sacrifice something? Yes. So remember, you see that you credit the ordinary share capital, the share premium, the reserve, what the shareholders are sacrificing, as well as the debt holder. Now, in this case, we have the preference shareholders, preference share capital. So you take the preference share capital, you want to determine how much they sacrificed. So the preference share capital we have is 10. And this 10,000 was to be exchanged. So you compare the two values. So I told that number 2. The existing preference shares are to be exchanged for a new issue of 55,000 15% preference share of 100 each. So they were given 55,000 preference share each at 100 plus and 500,000 equity shares of 4.5. Then they were given 500 shares each at 4.5. So first of all, let's get the exchange. So we take 55 to 100. That 500 times 4.5. So that means they were given a value of how much? Sorry? 77.50. Now that means in exchange for 10,000, the exchange for 77.50. So that they sacrificed how much? Yeah, they sacrificed an amount of 22.50. Correct. Number 3. The 12% debentures are to be converted into 15% debenture. Yeah, most of the debt holder, they don't lose. Actually, in this case, they are gaining. How? They told that the 12% debenture are to be converted into 15% debenture. So the interest rate to be increased from 12% to 15%. What's the reason? There is a reason. A further 1 million shillings or 15% debenture of 100 each are to be issued at 75. So for them, they negotiated that you give us more interest rate from 12% to 15%, and for us to inject an additional capital. So that was the deal. But that one won't affect the capital reduction because in this case, they have sacrificed nothing. So in that case, it could have only affected the cash account because they were to subscribe for, they were to inject more capital worth 1 million. So that one won't affect any of our account. Number 4, the directors agreed to forego 50% of their own. Their own is a liability. So you see that you credit what the debt holders and the shareholders are sacrificing. So we have directors loan. How much of the directors loan? 5,000. They agreed to forego 50% of that. So you're told that the directors agreed to forego 50% of their own. So that means they sacrifice how much? 2,500. So they have to receive the balance. How much is the balance? 2,500. Good. How was that settled? The balance of loan is to be settled by the issue of 400,000 equity share of 4. Did they sacrifice an additional amount? Yes. Also director's loan. Now, there is a balance of 2.5, of which now they are to be paid. But now they are to be paid through the issue of share. So you compare the value of the shares against the outstanding balance. So they are told that the balance of the loan is to be settled by issue of 400,000 equity shares of 4.5. So you take minus, they were given 400 each at 4.5. So can you take 400 and 4.5? 1,800. In exchange over that was how much? 25. So there was an additional of how much? 700. And then since the company now will issue additional shares, so that one will affect our ordinary share capital, that to pay for the director's loan, we issued 400 shares, each at 4.5, which was an amount, is it 18? 18. Also, we had this, the preference share capital, they had been given 500 each at 4.5. So for the preference share capital, we had exchanged the amount by issuing 500 shares, each at 4.5. How much is that? Yeah, 22.50. Yeah, because it was an exchange. So that means our ordinary share capital was increasing. Number five. The bank overdraft is to be repaid in full. We have to repay, that means they are sacrificing nothing. So that one could have affected our cash account in case we have to open the cash account, because that one is an outflow, and then you credit the bank overdraft. Now you credit the cash, and then you debit the bank overdraft. So there will be no longer ability. Number 6, all the intangible assets and accumulated losses are to be eliminated. Be eliminated, that means to be written off. And we say that you credit what you are to write off, all the assets written off and the valuation losses. So for the intangible asset, we had goodwill. So there is goodwill written off. And the goodwill written off, it's an amount of 5,000. Then you also had patent and trademark. Patent and trademarks, an amount of 500. Number 7, creditors are expected to be paid half of the amount due at a discount of 10. Creditors, they are part of debt holder, so they sacrifice. Can you compute for me how much they sacrificed? I want individual answers. How much was that? Just take 10%. You're getting? Sorry? No, I want the amount. You're getting 110. 110. 110. What about the rest? So the creditors, they were to sacrifice. Yeah. The creditors accepted to be paid half of the amount. So they never forgone the other 50. No. They accepted to be paid half. That one does not mean that they forgo the balance. No. But that half, if you pay them that half now, they give you a discount. So the only thing they are sacrificing is the discount. So what you'll do, you take 50% of the creditors, of which our creditors was an amount of 22. Half of it, that's 1,100, right? You pay them 1,100 now, but they'll give you a discount of how much? 10%. So what they sacrifice is on the discount. So 10%, which is an amount of 110. Good. Number 8, assets are to be adjusted to their fair values by the following amount. So those are the revaluation. So factor in, you see that revaluation was you credit. So we have for the plant machinery, then we have equipment, we have receipt, and then we have inventory. Now for the plant and machinery, was it again arose? Arose by how much? Arose by how much? 6100. That's correct. So we have 6100. We have that 250. And then we have 1160. And inventory of an amount of 460. In this case, you don't compare because in this case, remember those are the revaluation. You have been told that assets are to be adjusted to their fair values by the following amount, not to the following amount. If you are told that to the following amount, that's when you compare the carrying amount to the revalued amount. But in this case, they are to be adjusted by the following amount. And then during reconstruction, mostly you expect the value of the asset to reduce. So that's why it's a revaluation loss. Number 9, the share premium account is to be utilized for the purposes of capital reduction. So share premium, that's shareholder as well, so they sacrifice. How much was the value of the share premium? Yeah, it was an amount of 4,000. In that case, they won't sacrifice this. They only sacrifice what they had in the account. Good. Now add for me the total on the debit side. You got 26? 26,060. So this one will be 26,060. Then the balancing figure is what goes to that's 75. Yeah, 7590. Yeah. And this capital reserve is again, yeah, so it will increase the value of the equity or can add it as part of as an current asset. This is what it means. Remember, I said that you credit what they are sacrificing. So in this case, they sacrificed more than what they were supposed to write off. These are the amount to be written off. This is what they are sacrificing so that write off the accumulated losses. So they sacrificed more by 7590. What does that mean? That means when preparing the statement of financial position, this one will increase the value of the equity because it's still their wealth. What they sacrificed by sacrifice more than what they were supposed to write off. So now let's close off the ordinary share capital account. Give me the total. That's it. 550. We have that 8,550. Then we have the balance carried down. I get an amount of 850. 0.50. Good. Required capital reduction account format that is limited after completion of the internal reconstruction. So they just needed this account. Good. So you can copy that. Yeah, write it as part of the notes. Write it as part of the notes. Suggesting a scheme of reconstruction. Yeah, right, when a scheme of reconstruction is not provided, when a scheme of reconstruction is not provided, when a scheme of reconstruction is not provided, comma, it can be suggested, it can be suggested, can be suggested, can be suggested by adopting the following steps, can be suggested by adopting the following steps. Yeah, for example, the question, the one we have done, how do they determine that the share need to be written down from 10 to 4.5? So there must be a process, because number one, you have to determine how much do they need to sacrifice. So step number one, determine net loss. You determine net loss to be written off. You determine the net loss to be written off. You determine the net loss to be written off. You determine the net loss to be written off. Yeah, how do you determine the net loss to be written off? So you determine the net loss to be written off. In short, you are trying to determine the amount they should sacrifice. So you'll take the accumulated losses, then you add number one, the reconstruction cost. First of all, is a don't write. Then you also need to write off the goodwill. So goodwill written off. Then you devalue the asset. So in case there is a devaluation loss, you also write it off. Yeah, the loss of value of assets. Let's call it revaluation loss. Also, you add the gain value or revaluation gain for liability, gain in liability value. Then you deduct again. So you factor in the revaluation gain, factor in the unrecorded liabilities. Unrecorded liabilities, they include things to do with, for example, the interest was outstanding. Also, the preference dividend were in arrears. So that's what you call the unrecorded liability. Then this amount will be minimized by revaluation gain, in case there was any revaluation gain. Also, in case they had any revaluation reserve, the shareholder will have to sacrifice that. Also, they also have to sacrifice the share premium. That's how to determine the amount of net loss. The net loss is the amount that they need to sacrifice. You can copy that. Step number two. Step number two. Step number two. Determine, determine, determine who is to bear the loss. You determine who is to bear the loss. Determine who is to bear the loss. Then you explain and say that ordinary shareholder, ordinary shareholders, ordinary shareholders are the biggest losers, are the biggest losers, are the biggest losers, and they rank first, and they rank first, and they rank first, and they rank first to sacrifice their claim. They rank first, they rank first to sacrifice their claim. Full stop. They are followed, they are followed, they are followed, they are followed by the preference shareholders. They are followed by the preference shareholder. They are followed by the preference shareholders. And lastly, and lastly, and lastly, and lastly, the debt holders. And lastly is the debt holders. Lastly is the debt holders. Yeah. So now we can do an illustration. Take out your handout. Handout question 1, page 5. Handout question 1, page 5. And you're told that Mark Limited has been operating profitably until 3 years ago when it started experiencing financial problems. This resulted in the business reporting heavy trading losses. The directors are considering taking internal reconstruction. The statement of financial position of the company for the company as at that 1st of March 2015, before reconstruction, was as follows. So given the statement of financial position, yeah, now let's go. We have the non-current assets. We have the current assets. Then under capital reserve, we have the ordinary share capital, 10 shillings each, 9% cumulative preference share, 10 each. We have revaluation reserve, and then we have profit and loss account. Now that profit and loss account is negative, so that's what we call the accumulated losses. That's the accumulated losses, which is an amount of 650. Then on current liability, we have a 10% debenture. Current liability, we have the bank overdraft, trade payable, additional information. The cost of scheme of reconstruction was estimated at 4.5 million. Number 2, the dividend for preference share were 2 years in arrears. Number 3, the fair value of the asset as at 31st of March 2015 was as follows. Number 4, goodwill was considered valueless, so therefore you need to write it off. 5, assume that the internal reconstruction would be completed as at the close of the business on 31st of March 2015. Quiet. Suggest a suitable scheme for capital reduction for Mark Limited. You suggest for them. Now let's go back to the format or the first step. The first step, you see that the first step, you determine the net loss to be written off. Yeah, you want to determine how much they need to sacrifice and how to determine that. So number 1, they need to write off the accumulated losses. And then we said you add number 1, the reconstruction cost. Yeah, that's what we call the restructuring cost. And note number 1, you're told that the cost of the scheme of reconstruction was estimated at 4.5. So you add 4.5 million. Number 2, the dividend for preference share were 2 years in arrears. That's what we call unrecorded liabilities. So they also need to sacrifice so that they pay the preference dividend in arrears. So you add the unrecorded liability, and that is the preference dividends in arrears. So let's go back to the capital and reserves. We have 9% cumulative preference share. So you take 9% of the preference share capital, which is 300,000, so that you get the dividend per annum. But you've been told that there were 2 years in arrears. 27 times 2, do you get 54,000? Yeah. So they need to sacrifice that so that they can be able to pay that. Let's go to note number 4. Note number 4. Goodwill was considered valueless. So it's valueless, that means you write it off. So you also write off the goodwill. Goodwill written off. And the goodwill written off is an amount of 16. Also, you need to revalue the asset. So for revaluation losses, also that one, they have to sacrifice for it. So you factor in the revaluation loss. Let's go to note number 3. Note number 3. Note number 3. The fair value of the asset as at 31st of March 2015 was follows. So those are the fair value. And under building, the carrying amount was 720, then has been revalued to 777. Is it a gain or loss? That's a gain. Now for the gain, will be utilized in capital reduction. Number 2, we have furniture and equipment. The carrying amount was 480. Then the fair value is 435. That's a loss. So furniture and equipment. So you take 480 minus 435, and that's a loss by 45. And then we have the motor vehicle. Motor vehicle, the carrying amount was 90, and the fair value is 45. So that's a loss. That's a loss also by 45,000. Inventories. the carrying amount was 240 and then was written down to 210. That arose by how much? 30. Interest also it's a revaluation loss arose. And then we have the trade receivables. Trade receivable, the carrying amount was 1020. Then the fair value is 939. So trade receivables. That arose by how much? Sorry? 81,000. Then you can deduct in case there was any revaluation gain. So there was a revaluation gain on land and building. Now that one reduced the amount of their claim. So land and building from 720 to 777. That's an increase by 57, right? Yeah, 57. For revaluation gain, that one reduced their claim. Then there is something we said. For the ordinary shareholders, they have to sacrifice any of their reserve, share premium, revaluation reserve, general reserve. Yeah. Can you go to the equity? The equity. What do we have of the shareholders? Yeah, we have revaluation reserve. So we also have to sacrifice that in capital reduction. So there was a revaluation of an amount of 400 and premium. The share premium could be utilized for capital reduction. I think we have everything. So now give me the net loss. You're getting 427. 500. 427. 500. So that's the amount now they need to sacrifice. Yeah, mostly the biggest losers we see that the ordinary shareholders and the preference shareholder. All right, let's go. And how much was the ordinary share capital? How much was the ordinary share capital? 450. And then the amount to be written off is 427,500. Yeah, when the ordinary share capital is more than what to be written off, so the first priority of the biggest losers will be the shareholders. They are the one to sacrifice. So what you'll do, now you want to determine now loss per share. So this what now the ordinary shareholders will sacrifice. So you'll take 427,500. You divide by the number of ordinary shares so that we determine the loss per share. How many ordinary shares do we have? Yeah, we have 45,000. So how much will be the loss per share? 9. Sorry? 9.5. So that means the ordinary shareholders, they need to sacrifice 9.5 shillings per share. How much was the par value? 10. And then they sacrifice 9.5. So that means the share should be written off, should be written down to how much? Yeah. Shares to be written down to 0.5. That is 10 shillings, you minus 9.5 and you get 0.5. Required. We have not answered the question. Suggest a suitable scheme of capital reduction. So first of all, you can copy that before you write the suggestion. So now let's answer part A. Part A, you want to suggest a suitable scheme of capital reduction for Mark. So now let's write that. Right? Number one. Ordinary share capital, ordinary share capital, ordinary share capital to be written down. Sorry, ordinary shares, not capital, ordinary share to be written down to 0.5 shillings per share. Ordinary shares to be written down to 0.5 shillings per share. 0.5 shillings per share. Number two, accumulated losses to be written off. Accumulated losses to be written off. Accumulated losses to be written off. Number three, preference dividend in arrears to be paid. Preference dividend in arrears to be paid. Preference dividend in arrears to be paid. Another one, reconstruction cost of 4.5 million. Reconstruction cost of 4.5 million to be incurred. Reconstruction cost of 4.5 million to be incurred. Construction cost of 4.5 million to be incurred. And another one, goodwill to be written off. Goodwill to be written off. Another one, a revaluation reserve to be utilized in capital reduction. Revaluation reserve to be utilized. Revaluation reserve to be utilized in capital reduction. Assets to be revalued. Assets to be revalued to the above amounts. Assets to be revalued to the above amounts. Assets to be revalued to the above amounts. Good. And number B of the question. Number B, to prepare the capital reduction account. Capital reduction account. So how do we prepare the capital reduction account? So we say that to credit what they were to be written off. Number one is the accumulated losses. An amount of 615. Also the goodwill written off. Yeah, we wrote off the goodwill, of which the goodwill written off was an amount of 16. Also, we factor in the revaluation losses. Revaluation loss for assets. And we have revaluation loss. Number one for furniture and equipment. Arose by 45. Then we have the motor vehicles. Also an amount of 45. We have inventories. An amount of 30. Then we have trade receivables. An amount of 81. Then, also when they are sacrificing this amount, they also need to sacrifice number one. They incur some costs to do the reconstruction, so they have to sacrifice that. So you factor in the reconstruction cost. They need to sacrifice an additional 45. Also, they have suggested that to pay the preference dividend in arrears. So they also have to sacrifice that. So preference dividends in arrears, which was an amount of 54. Now give me the show on the debit side. How much are they supposed to sacrifice? 934? 500. Good. Then on the credit side, number one, they need to sacrifice or they sacrifice ordinary share capital. And the ordinary share capital sacrifice is this amount. Or alternatively, you can do this. You take the number of share, they have 45,000 shillings. I mean 45,000 shares. Then each share, they sacrifice how much? 9.5. 9.5. Good. So how much is in total? 427? 500. Also, they sacrificed their revolution reserve. Revolution reserve, an amount of 50,000. Also, you see that here you have revaluation loss. In case there is a revaluation gain, you credit. So, because that revaluation gain will be utilized in capital reduction. And there was a gain for landed building, which was an amount of 50. Add the total on the yeah, you get 934. Yeah, 934. Lastly, number C. Opening statement of financial position as at 1st of April 2015, after conclusion of the capital reduction scheme. Yeah, so after reconstruction, how will the statement of financial position look like? Oh. So as at 1st of April 2015, we have the non-current assets. Non-current assets, we have landed building. So take the revalued amount. Landed building was equal to how much? Yeah, 777,000. And then there is furniture and equipment. Which was revalued to 435. And then we have motor vehicles. Motor vehicles was an amount of 45. And then we have the current assets. And the current assets, we have inventories. Also, it was revalued, so we take the fair value, was revalued to 10. And we have trade receivables. Trade receivables revalued to 939. Have the total? And then equity and liability. Ordinary share capital. Now, ordinary share capital, you can do this. How much was the ordinary share capital? What did you have? I mean, how much was the ordinary share capital? Sorry? So the ordinary share capital was for 50,000. Then you deduct the ordinary share capital that was reduced, amount of 427,500. Or alternatively, you take the number of shares, which we have with 45,000, and then the shares were written down to 0.5. You get an amount of 22,500. Then we had a 9% cumulative preference share capital. So you have the preference share capital, and the preference share capital is an amount of 300,000. There was revaluation reserve, but revaluation reserve was utilized in capital reduction. And so we have a non-current. And current liability of 10% debentures. An amount of 500,000. Then we have the current liabilities. Current liabilities, we have the bank OD. Bank overdraft was an amount of 500,000. Then we have the trade payables. Trade payables was an amount of 1025. Then, since we are making a suggestion, there are some expenses that we need to incur, but we have not yet paid. So therefore, they become liability. For example, we have proposed that we need to incur a cost of 4.5 in case we reconstruct, but we have not yet paid. So that one becomes accrual. You expect to pay in the near future. So we have reconstruction costs. We have not yet incurred. We are just suggesting 4.5. And then we have also suggested that we need to pay the preference dividend in arrears. So that one becomes a current liability. So preference dividends in arrears, which was an amount of 54,000. Add the total. Yeah, 24,000. As far as that. So now let's copy. Let's open the one for December 2023. Question 5. Question 5, you heard that. For a number of years now, A Limited has been reporting operating losses, principally due to competition from the firms operating in the same sector. A Limited is now considering reorganizing its operation and financial structure to allow it to obtain a new funding required to develop and launch new products. Technical experts have indicated that the new product will do well in the market once it's launched. So the statement of financial position of A Limited as at that 1st of October 2023 is as follows. So you have the non-current assets. Then we have equity and liability. Now, under the equity and liability, we have ordinary share capital. We have 20% cumulative preference share capital. Then we have retained earnings. Now, if you look at the retained earnings, they are negative. That's what we call the accumulated losses. So an amount of 29.18. Then we have non-current liabilities. We have current liabilities. Additional information. Preference dividend have been in arrears for 3 years. Preference dividend, they were in arrears for 3 years. So you add, that's what we call the unrecorded liability. So take the accumulated losses. The first step is to determine the net loss to be written off. First of all, can we go to the record? Let's go to the record. Suggest a scheme of capital organization that would be acceptable to all stakeholders, including a revised statement of financial position. So the first step, you determine the net loss to be written off, which is 29. First of all, you take the accumulated losses. Then you add unrecorded liabilities. So number one, we had the preference dividends in arrears. So number one, you took that. Preference dividend have been arrears for 3 years. So we compute that. So you take 20% of the preference share capital of 1,500. Then they were in arrears for 3 years. What do you get? 900. Number two, the retained earning balance is to be eliminated. Now that retained earning was the accumulated losses, which is 29. So it's part of what is to be written off, so to be eliminated. Number three. As well, tangible assets. 15% of the book value is to be transferred to the bondholder for an agreed value of 720 million in full settlement of the debt, and the remaining book's value of the asset marked up to 10%. So there is something you say to indicate. For liabilities, in case it's a what? It's a gain. You do what? Can you go back to the format you wrote? Net loss to be written off. Yeah, an increase in value of liability. That one is a loss, right? That one reduct. What if the liability reduces the in value? That's what we call a revaluation what? Let me take you back to IAS 19. So you did employee benefits, A reduction in liability becomes a what? Ama tu kusoma by actual gain and actual losses. It's an actuarial gain. Good. But when liability increases, becomes a loss. So now in this case, there is tangible assets. Yeah, tangible assets, 15% of the book value is to be transferred to the bondholders for a great value of 720. So tangible assets. So you take 15%. How much was the value of the tangible asset? Yeah, it was an amount of 5,000. How much is that? 700. Now this one was transferred to clear a debt of how much? So tangible asset, 15% of the book value is to be transferred to the bondholders on an agreed value of 720. So we transferred asset worth 750 to pay for a debt worth how much? 720. So is it again or loss? I want to give you that second to think. Can you think on that?
It's a loss.
Is it again or loss? A loss, eh? Yeah. So it's a loss by how much? Yeah, a loss by that. Good. Yeah, because we are paying off a debt. And that debt is worth how much? 720. But we give them asset worth how much? 750. So it's a loss by how much? That. So we do add it, we do this. That one you add. Good. Yeah. Then you are told that, and the remaining book value of this asset marked up to 110. Marked up. So in short, there was also the valuation gain. Eh? Yeah. The valuation gain of tangible assets. That's very simple. So 15% will be transferred. The balance is how much? So you take 85% of 5,000. So how much was the value? 42. Then they were to be marked up by 10. So in short, there was a gain by 10. Eh? So 10% of that is an amount of? Is it 425? Yeah. Now these are the valuation gain. For the valuation gain of an asset, will you add with this?
Yes.
Yeah, that one you did. This one was a gain of asset. Now this gain will minimize the amount to be written off. So that one, that. Yeah, and therefore the amount to be taken out of the statement of financial position will be 4250 times 110%, or you take 4250, you add 425 to determine the amount now to be recognized to the statement of financial position. Second bullet. Inventories include obsolete items worth 540 below their book value of 680. So inventory or obsolete. Inventory is part of the asset. So there was also value. Obsolete by how much? By 40. We had the readers. A revaluation loss of an asset. You do what? Yeah, that one we add. Good. That bullet. About investment, having 10 months to maturity date is to be revised to 280 million from its carrying value of 370. Board investment. Is it an asset or liability? It's an asset, yes. Board investment. That one is an asset. Yeah, we are told that about investment, having 10 months to maturity date is to be revised to 280 from its carrying value of 370 to 280. A bond investment, that one is a financial asset. That's what we call applicable for sale. So that means there was a revaluation loss by how much? 90. Yeah, that's a revaluation loss of an asset, reduction in value. So you add it. Fourth bullet, receivables with carrying value of 1,200 are to be factored out for 70% advance at the terms that will allow for refund of any difference between the actual collection and the upfront payment from the factor. Now that one they are sacrificing nothing. Do you know what's called factoring? Factoring, this is where you transfer the account receivable to an external party. It's like being a landlord and then you decide to hand over your building to an agent. What they usually pay? So sometimes they pay in lump sum, eh? Yeah, so they run out of that. So in this case, they give you a pot of 70%. So that one does not affect this. Another one customer who owes 828 million is in serious financial difficulty. Only 50% is expected to be received from this customer in 1 year's time. What does that mean? So that means we need to write off some bad debt. That's what we call the bad debt. Yeah, because you are told that one of the customers who was 828 million is in serious financial difficulty. Only 50% is expected to be received. So that means they won't receive the other 50%. And this 50%, they receive it after 1 year. So that was a reduction in receivable. So 50%, that's bad debt. 50% of 828. You get an amount of, is it 414? 414. Then the other balance for 414 to be received in 1 year time. Can you underline that? In 1 year time. Be received in 1 year time. And so there is something I want us. First of all, let's go to note number 10. Let's go to note number 10. Go to note number 10. The present value of 1 shilling receivable at the end of the year for different discounting rate is provided below. Number 9. Assume a discount rate of 15% unless a different rate is more appropriate. Okay. So there is something I want us to compare here. Yeah. So of the receivable 828, 50%, that one we won't receive. But the balance of 414, we receive it. But you're not receiving now. We are receiving in 1 year time. But you're told that in this case, the company, they have a cost of capital. So therefore, you need to discount the present value. Can you go to note number 9 again? Assume a discount rate of 15% unless a different rate is more appropriate. Then you are told that number 10, the present value of 1 shilling receivable at the end of the year for different discount rate is provided below. Our discount rate is 15%. Now let's go, we have 15%. 15%. And then we expect to receive them in 1 year time. So what's the present value factor? 0.87. So how much are we losing now? This is what you'll do. You will take 414. You will take 414. This is what you have to receive in 1 year time. But now, how much is the present value? Because now you have to receive in 1 year time. So we'll take 414 times 0.8. Is it 87? Okay, so this is what I'm doing. Can you take 414 times 0.87? You get the present value. Now that is the present value, right? But the amount we have to receive was how much? 414. So due to the time value of money, how much have we lost? 53 point? Yeah, let's work with 54. Or alternatively, you can do this. If 1 shilling receivable in 1 year time has a present value factor of 0.87, how much are we losing? So just take 1 minus 0.87 and you are losing 0.13. Then you multiply by the amount receivable in 1 year time, which is 414. How much do you get? You still get that 54? Yes. And this one was a loss, so you add it. Number 4. The bank has demanded a repayment of the bank overdraft. While the finance institution has accepted to receive 92% of the existing loan in new ordinary share as full settlement. Loan from financial institutions. Now, how much of the loan from financial institutions? It's an amount of 925. So they have accepted, they do an equity swap. they get 92% of the shares. So that means the debt holders, they have sacrificed an amount of how much? Let's read again. The bank has demanded, we are note number 4, the bank has demanded a repayment of bank overdraft, while the finance institution has accepted to receive 92% of the existing loan in new ordinary share in full settlement. They were given 92% worth of share. So that means in that case, they sacrifice how much? 8%. How much will you get? 74. Eh? Now the question is, we add or we less? Is it again or loss? Okay, this was a loan, right? Now, of this 925, the loan has lost value by 8%. There is a reduction in debt by 74. Is it again or loss? That's again, reduction in a debt is a gain. So again, we'll minimize our credit. So that one would die. We're still in note number 4. Upon successful completion of the reorganization process, however, the finance institution is ready to immediately buy 15% 900 million debenture in the reconstructed entity's debt, provided that the directors will attach the right to convert the debt into shares at maturity. That's a compound debt instrument. And that one you have to amortize to get the debt element, what will take to the non-current liability. You also need to determine the equity element to be taken to the equity. Yeah, we did that one under IFRS 9 financial instrument because these are financial instrument. They want to inject more. 900 million in debentures, but they want to be given a conversion, right? Then we are told that the finance institution will also require 10% discount on convertible debt at issue. 10% discount. Discount of how much? How much are they issuing? They'll give a discount of how much? Are you getting anything? You know, I'm worried. Eh? Sasa walifanya hii karatasi hiyo kitu, kuna kitu waliona kweli? Yeah, but actually this was one of the easier paper to pass, because someone who has been able to interpret up to that point without preparing the balance sheet, they already have 12 marks up to that point. So that means if you panic, you get 0. Panicking, that means you even don't understand the question, where to start. Yeah, but if you have an idea that the first step is this, and then you try to just, you know what to do. It's all about working smart. Yeah, that's why the first mark is 50. Prove to them that you can be able, this question is 20 marks, you can be able to answer half of it. Are you together? And because I can see you're not getting anything, take a screenshot of that. You'll do it. We'll do it during our revision. Not tomorrow. Tomorrow I have to start afresh because you're not remembering anything. Just take a screenshot for that. There's no need for us to waste time. And that question was extracted from Chartered Financial Analyst paper, on strategic financing. Yeah, there it is. I will write something else. So you're done with internal reconstruction. External reconstruction. Let's introduce on external reconstruction. External reconstruction, right? You see that? And this is where the existing company is wound up. And this is where the existing company, this is where the existing company is wound up, This is where the existing company is wound up due to financial problems, is wound up due to financial problem, and its business taken over, and its business taken over, and its business taken over, and its business taken over by a new or an existing company, and its business taken over, and its business taken over by a new or existing company. Yeah, that's what we call external reconstruction. So in this case, they are a new company taking over the business. So if the new company is taking over the business, that means there is a liquidation, because for a company to take over another company, you liquidate that company to form a new company. Internal reconstruction, there was no liquidation. Then I have to say that in case of this takeover, comma, the purchase consideration needs to be determined. Purchase consideration need to be determined. You know what is purchase consideration? The amount that the new company will have to pay in order to acquire the business of the company that's being wound up. Can I see that? The purchase consideration will include semicolon A amount payable to ordinary shareholders amount payable to ordinary shareholders. Number two, amount payable to preference shareholders, amount payable to preference shareholders, amount payable to preference shareholders. Number three, amount payable to debenture holders, amount payable to debenture holders. Another one, reconstruction cost. I want us, we explain something on reconstruction cost. Say that. This will be treated as a preliminary expense. They shall be treated as a preliminary expense. And therefore should be capitalized. Yeah, that's the cost to incur. And mostly it would be incurred by the predator. The company taking over the other company, they are the one to incur that reconstruction cost. And since we're incurring in the process of forming a new company or taking over the other company, now that cost will be treated as preliminary expense and therefore should be capitalized, will be part of the non-current asset. That's what we mean by capitalized. Good. So now let's look at something else. Accounts prepared to close off the books of account, accounts prepared to close off the books of account, accounts prepared to close off books of account, accounts prepared to close off books of account of the company in financial problem, Yeah, number one. So what are those accounts we prepare to close off the books of the company in financial record? Number one, ordinary shareholders members account, ordinary shareholders members account, ordinary shareholders members account. Number two, preference shareholders members sundry account. Preference shareholders members sundry account. Number three, debentures account, debentures account, debentures account, debentures account. Another one, purchasing company account, purchasing company account, purchasing company account, stroke vendors account, stroke vendors account, purchasing company account, stroke vendors account. And then lastly, realization account. Lastly is realization account. Realization account. Those are the major accounts prepared to close off the books of the company in financial problem. Now we look at journal entries. Journal entries to record takeover. Journal entries to record the takeover. Journal entries to record the takeover by the new company. Journal entries to record the takeover by the new company. Number one. Assets taken over. Assets taken over. Assets taken over. Semicolon. So you debit assets account. You debit assets account. You debit assets account. You credit business purchase account. Credit business purchase account. Business purchase account. Number two. Liabilities taken over. Liabilities taken over. Liabilities taken over. Liabilities taken over. Semicolon. You debit business purchase account. You debit the business purchase account. You credit liabilities account. So that you debit the business purchase account, you credit liabilities. You credit liabilities. Number three. Goodwill. Goodwill on acquisition. Goodwill on acquisition. Goodwill on acquisition. Semicolon, Roman 1. Semicolon, Roman 1. Goodwill. Goodwill. And then you debit goodwill account. You debit goodwill account. Goodwill account. You credit business purchase account. Business purchase account. Business purchase account. I debit the goodwill, credit the business purchase account. Number two, there is what we call negative goodwill. And negative goodwill is known as the capital reserve. Negative goodwill stroke capital reserve. What do you debit? What do you credit? You debit. You debit business purchase account. Debit business purchase account. You debit business purchase account. You credit. You credit capital reserve account. Capital reserve account. Capital reserve account. And then lastly, number four. Number four. With purchase consideration. With purchase consideration. With purchase consideration. With purchase consideration. You debit business purchase account. Debit business purchase account. You credit vendor's account. You credit vendor's account. You credit a vendor's account. Good. Yeah, we can stop there for today. So in the next session, we'll be doing now question on external reconstruction. So kindly keep time on our next session.